On February 21, 2025, the U.S. Department of Commerce made a final decision on tariffs for Southeast Asian solar panels, raising rates from 21% to a staggering 846%. This hit Chinese solar giants hard, despite their efforts to disguise operations under Malaysian and Vietnamese labels. For over a decade, companies like Jinko Solar and Longi Green Energy have built supply chains in Southeast Asia, believing they could bypass US tariffs. But with this move, the US has exposed their strategy, making it clear that Chinese-made products remain at the center of the issue. The tariff dispute began on April 24, 2024, when the US Solar Manufacturing Trade Committee filed a complaint. It accused Malaysia, Thailand, Vietnam, and Cambodia of serving as transshipment hubs for Chinese manufacturers, undercutting American companies with low prices. Within just 10 months, the Commerce Department launched an investigation on May 15th, issued preliminary tariffs ranging from 21% to 271% on November 29th, and finally delivered the 846% penalty on February 21st. This means that a $100 solar panel could now cost anywhere from $370 to over $900, making it unaffordable for many buyers. The decision effectively dismantles years of overseas expansion by Chinese solar companies. This trade dispute traces back to 2011, when the US first imposed anti-dumping and countervailing duties on Chinese solar products, ranging from 18.3% to 250%. In 2015, a second round of tariffs shut down direct exports from China, forcing manufacturers to shift production to Southeast Asia. Malaysia, Thailand, and Vietnam became ideal locations due to abundant sunlight, ranging from 1,460 to 1,900 kilowatts per square meter annually, and favorable policies, including subsidies and tax exemptions. Leading Chinese solar companies, Longi, Jinko, and Trina Solar moved in, establishing a full supply chain from silicon wafers to solar modules. The expansion accelerated in 2013. Jinko set up a gigawatt-scale plant in Penang, Malaysia in 2015. Trina built a factory in Thailand in 2016, followed by Longi opening operations in Vietnam. By 2021 to 2023, 80% of US solar panel imports came from these four countries, with Chinese manufacturers dominating the supply. Over 10 years, Chinese companies earned between $50 billion and $100 billion, controlling 75% of the US market. The US responded in May 2024. The Biden administration reinstated Southeast Asian solar tariffs, doubled the Section 301 tariff on solar cells from 25% to 50%, and ended exemptions for bifacial panels on June 6th. The Commerce Department's anti-dumping and countervailing duty investigation followed, culminating in the February 21st decision. Let's take a look at the specific tariff rates. Jinko Solar will face a 19.8% tariff in Malaysia and 74.7% in Vietnam. Trina Solar has been hit with 91.4% in Thailand and 62.9% in Vietnam. JA Solar, a second-tier manufacturer, will see a 56.2% tariff in Vietnam. Sungrow, operating in Thailand, is facing a rate of 228.5%. Meanwhile, Jinko PV and AOI Solar, both based in Cambodia, have been given an 847% tariff. These penalties specifically target companies that did not fully cooperate with the investigation. The impact was immediate. Even before the final ruling, Chinese solar panels were struggling to sell in the US as customers backed out, leaving factories idle. Longi's $2 billion 6.6 gigawatt silicon ingot project in Malaysia and JI Solar's a few billion worth 3.5 gigawatt cell plant in Vietnam have both shut down. Trina's Thailand facility is set to close by the end of May, with its battery production lines stopping in mid-June. On June 5th, Longi's chairman Lee Cheng-kuo insisted they were evaluating operations and considering keeping some production in Southeast Asia as a backup. Trina Solar announced its facilities in Thailand and Vietnam would enter annual maintenance, but many observers saw this as an attempt to downplay the situation. The region, once a hub for Chinese solar manufacturing, is now at a standstill. Financial losses are mounting. In Q1 2024, Longi Green Energy reported revenue of 17.6 billion yuan, down 37.6% year-over-year, with losses of 2.4 billion yuan, a 164.6% decline. Jinko Solar's revenue fell 0.3% to 23 billion yuan, with net profits down 29%. Trina Solar's revenue dropped 14.4% to 18.2 billion yuan, with net profits plummeting 70.8%. JA Solar's revenue fell 22% to 15.9 billion yuan, with a loss of 483 million yuan, down 118.7%. Among the 6 largest solar companies, 5 are expected to post combined losses of 31 to 34.1 billion yuan. China's solar industry also faces intense price competition at home. Despite a total output of 1.7 trillion yuan in 2023, polysilicon and module prices fell by over 50%. Longi alone wrote off 6.7 billion yuan in inventory, with 1.4 billion yuan lost due to US policy changes that stranded shipments at ports. For years, China promoted its global expansion strategy. Now, with the US cutting off key trade routes, Chinese solar firms are left with empty factories and mounting losses. The bridge through Southeast Asia has collapsed, and even tougher challenges may lie ahead. In December 2024, the US Department of Commerce took a retroactive action, imposing additional tariffs of 30% to 230% on 30 to 40 gigawatts of duty-free solar panels imported between November 2022 and June 2024. These were stockpiled by Chinese companies during the grace period, expecting to use them before the June 2024 deadline. However, on December 3rd, after the deadline expired, the US refused to honor the exemption. Billions of dollars worth of inventory were left stranded, dealing a major financial blow to Chinese manufacturers. This move signaled that even previously allowed shipments would not be spared. The impact extended further. JSC Cambodia's Solar Long PV Tech, despite appearing to be a local Cambodian manufacturer, was hit with an 847% tariff, exposing its Chinese ties. Malaysia's Powerwell New Energy faced a 206% tariff, while Vietnam's GEP New Energy and HD Solar were subjected to a 563.9% rate. Even smaller second and third-tier suppliers could not escape the penalties. With soaring import costs, US buyers pulled out, production lines stalled, and factories faced shutdowns. With these tariffs in place, Chinese solar manufacturers in Southeast Asia now need to find alternative markets. Some production will shift to China's domestic market, but demand in Southeast Asia itself is limited. Many Chinese investments in the region have already exceeded local needs. In Malaysia, for example, over 90% of Chinese-made solar panels were previously exported to the US. Additionally, domestic buyers often avoid locally produced panels due to high costs. The shortage of skilled labor and the country's industry structure make manufacturing solar panels in Malaysia even more expensive than in China. Quote, unless it's a government-led project that requires Chinese companies to use locally produced components to qualify for bidding, most private firms will still prefer to import the cheapest solar panels directly from China to maximize profit margins. Unquote. Some production may shift to Europe, though risks there are also rising. Early last year, the Solar Manufacturing Council sent a letter to US lawmakers calling for strict regulations on forced labor in the solar supply chain, specifically mentioning Chinese manufacturers. Europe now requires traceability documents for imported solar panels to prove they are free from forced labor. Many China-made solar products struggle to provide such documentation, making it difficult for them to enter both the US and European markets. Working conditions at overseas factories have also worsened. Employees at Chinese-owned solar factories in Southeast Asia have reported consecutive months of pay cuts. In August, overseas subsidies were reduced by 2,000 yuan. In September, performance-based bonuses for engineers in higher positions were also cut. For workers below the engineering level, salaries were reduced by 0.2 yuan per unit. With no prior notice, the deductions simply appeared on their paychecks. With factories struggling, workers face financial hardship. Tariffs are one challenge, but domestic issues have also taken a toll. In 2023, China's solar industry reached a record total output of 1.7 trillion yuan, but a fierce price war led to polysilicon and module prices dropping by 50%. While export volumes increased, unit prices fell, causing profit margins to plummet by 70%. At the 2024 SNEC Solar Conference, GCL Group Chairman Zhu Gongshan stated, quote, "The industry has entered an ice age. This is the most intense competition in history. Production capacity has tripled, completely disrupting supply and demand." In Vietnam, local companies have been forced to downsize or shut down entirely. While some businesses survived the pandemic, they could not withstand U.S. trade restrictions. Many Chinese traders arrived in Vietnam with high hopes, but within 2 months, some had to shut down operations and sell off equipment as scrap. As factories in Southeast Asia turn into ghost towns, the situation in China has also worsened. Among the 6 largest solar firms, 5 posted a combined loss of over 30 billion yuan. Smaller manufacturers faced even greater struggles, with dozens declaring bankruptcy in the first half of 2024. Some were unable to pay severance and simply locked their doors without notice. A viral post on Douyin described a company that had expanded into the solar industry but failed to pay wages for 3 months. The company's bank account had only 130,000 yuan left, while suppliers stood outside demanding payment. Frustrated workers openly complained, saying, quote, "The solar industry destroyed us." With U.S. trade restrictions tightening and internal struggles mounting, the challenges for China's solar industry continue to grow. A major development surfaced on Douyin, Chinese version of TikTok. State Grid's Guangyi Bao, a platform that helps users collect electricity payments from leased solar panels, is shutting down all transaction services. Even millions of existing solar panel users will be affected. For farmers who installed solar panels, electricity sales were previously processed through Guangyi Bao. Now, State Grid will transfer payments directly to their secondary bank accounts. This move has stunned investors and platform operators. Without transaction fees, the platform loses a major revenue stream, leading to significant financial losses. Industry analysts estimate that most of China's residential solar leasing market relies on this model, involving massive amounts of capital. While individual users benefit from receiving payments directly, platforms and investors face serious losses. The more solar stations they previously installed, the greater the financial hit. In addition, switching and linking new bank accounts with farmers will be a logistical challenge, potentially causing disputes. Salary cuts and layoffs have intensified. Videos in Douyin show solar industry workers struggling with wage reductions of 20 to 30% around Lunar New Year. Some major companies have given employees just 30 minutes to decide whether to accept layoffs. One near first-year company has switched to a 4-day workweek, cut 80% of its budget, eliminated bonuses, and delayed salary payments. Labor disputes are on the rise. Industry experts predict that new solar installations in 2025 could drop to 150 gigawatts, nearly half of the 270 gigawatts installed in 2024. Some warn that investment could grind to a halt in the second half of the year. With Southeast Asia no longer a viable market, Chinese solar companies are now searching for new opportunities worldwide. Indonesia has emerged as a potential option. In 2023, it signed an 11 gigawatt electricity export agreement with Singapore. Trina Solar has also built a factory in central Java. However, Indonesia faces major infrastructure issues, slow logistics, and unstable policies. The Middle East is another attractive market. Saudi Arabia has strong solar potential and significant financial resources. Companies like TCL Zhonghuan, Jinko Solar, and Longi have all entered the region. However, political instability raises concerns about the safety of investments. Some observers have commented on Douyin that these companies are betting on a mirage in the desert. On December 1st, Malaysian Deputy Minister Liu Qingtong warned, quote, "Don't use us as a transshipment hub to bypass US tariffs. That strategy won't work," unquote. Africa, India, and Brazil have also been discussed as potential markets. Analysts point out that Africa has 600 million people without electricity and accounts for 60% of global solar resources, yet its solar installations remain at just 1%. India has a population of 1.3 billion, strong electricity demand, and significant government subsidies. Brazil has vast land resources and the government pushing for energy transition. However, challenges remain. Africa lacks infrastructure, India's policies are unpredictable, and Brazil has slow investment returns. While global energy transition efforts call for 3,473 gigawatts of new installations by 2030, global solar manufacturing capacity has already reached 7,310 gigawatts, more than double the expected demand. If developing nations rapidly expand their solar sectors, it could provide relief for Chinese manufacturers. However, Africa struggles to attract sufficient investment, raising concerns about how China's surplus production can be absorbed. Indonesia's island-based geography makes transportation costly. Africa's infrastructure remains underdeveloped. Brazil's political environment is uncertain. None of these markets offer stable ground. For Chinese solar companies to succeed in the US market, they may have no choice but to fully localize operations no matter the cost. Jinko Solar took an early step in this direction, opening a module factory in Florida in 2019. In 2023, more companies followed suit. Trina Solar invested $200 million in a Texas facility. Longi built a 5-gigawatt module plant in Ohio. JA Solar and Canadian Solar also expanded, bringing total production capacity in the US to 18 gigawatts. On November 6th, Tianhong Solar announced a swift move to exchange assets for shares in a US-listed company, accelerating its localization strategy. However, the US has a history of shifting trade policies quickly. On January 1st, under the Section 301, the US raised tariffs on Chinese polysilicon and wafers to 50% and on tungsten products to 30%. Even Chinese solar companies that have built battery and module factories in the US must now relocate their upstream polysilicon and wafer production or face heavy tariffs. In recent years, Chinese solar firms planned battery factories in Mexico, main production sites in Canada, and inverter storage facilities along the US-Mexico border. But with Donald Trump's return to office, new tariffs targeting China, Canada, and Mexico were introduced, disrupting these plans. The entire strategy now requires reassessment. This is not just a trade dispute, it is a high-stakes battle over global supply chains. Why has the US taken such aggressive action? Analysts suggest that continued Chinese underpricing would not only damage the American solar industry, but also give Beijing control over the entire Western supply chain. Energy security and domestic manufacturing are strategic priorities for Washington. In recent years, the US has promoted supply chain reshoring and friendshoring to reduce reliance on China. The Inflation Reduction Act allocated $750 billion to support domestic solar production. However, Bloomberg data reveals a major gap. In 2022, US module production capacity stood at just 7 gigawatts, two-thirds of which still relied on Chinese imports. By June 2024, the US removed tariff exemptions for Southeast Asian solar panels. Now, with rates rising as high as 846%, the goal is clear: to eliminate Chinese competition from the market. What comes next? The US is expected to strengthen alliances with India, Indonesia, and Brazil to build a solar supply chain independent of China. A viral post on X pointed out that, quote, Chinese solar panels are so cheap in Germany that they're being used as fencing materials, unquote. The underlying issue is overcapacity. China has an annual production capacity of 1,000 gigawatts, while global demand stands at just 500 gigawatts. With inventory levels sufficient for a decade, the industry has relied on subsidies and aggressive pricing to maintain momentum. Now, the US has rejected these tactics, Europe is tightening labor regulations, and India has launched its own anti-dumping measures. China's solar industry faces mounting pressure on all fronts. After this battle, Chinese solar companies have taken heavy losses. The US tariffs not only crippled factories in Southeast Asia but also shattered Beijing's ambitions for the North American market. With foreign trade restrictions tightening and domestic overcapacity surging, factories have shut down, workers have been laid off, and the industry is in chaos. Indonesia and the Middle East seem promising but remain uncertain. Africa and India present opportunities but come with major risks. Setting up factories in the US comes with restrictions. Every path forward is challenging. For years, China promoted its global expansion strategy. Now that expansion has unraveled, leaving behind a collapsing network. How long can these companies hold on? Will they keep fighting a losing battle or cut their losses and retreat? The answer remains unclear, but one thing is certain. China has already lost big in this game. The next move is up to the US and its allies.